Hello everyone. So people who've been following my channel will know that I've been posting a series of videos about investing in shares, share trading, basics of share trading, and people who've never done share trading. I've kind of been teaching how to do share trading and how easy it is once you understand a very few basic concepts. And I've also, for people in UK, I've also explained how you can do share trading in UK without tax implications, and what kind of shares I have bought, so that you can probably take some note from the shares that I bought. And if you want, you can do your own research and you can buy the same shares as well. Most of the investment that I've done this year, I had never done share trading before in my life. This is the first year that I've started share trading, and a lot of these concepts are concepts that I taught myself. I learned myself, reading various things, spending a lot of time researching into what these are, what these concepts are. So I've kind of narrowed it down to a few strategies, which has helped me avoid big losses, which has helped me make a good amount of profit in a very short span of time. I've been doing this probably for about 5 or 6 months now, and I have not made a loss, and I have probably made a very good profit, I would say, decent profit, I would say, to my expectations. If somebody had told me that I would make this profit when I had started, I would probably have taken it. So I have basically put it down into a few strategies in a document, and I'll probably walk you through some of these strategies. Some of them are generic, some of them probably apply to certain legislations, but the concepts are all the same throughout. So let's go into it and take a look at it. So first thing is, I've already explained in previous videos, how the share prices go up and down, what market maker is, what shorting is, what is a placement, why do the prices go up and down. I've kind of explained it. So you need to understand this so that you can mentally be prepared when a share price falls or when a share price increases. So when you are into trading, right, there are only 4 types of trades. There are only 4 types of events that happen. One is a big win, you win big. It's a small win, small loss, or a big loss. And the truth is, the reality is that if you are trading for a few months, no matter how long you've been trading, you will always face these 4 scenarios once in your life, at least. That you will always face one of these 4 scenarios in share trading. And the objective or the goal is to eliminate number 4, eliminate the big loss. Once you find out what is the reason for your big loss and you eliminate it from your share trading, your big wins are going to basically compensate for your overall wins. Your small wins and small losses are probably going to negate each other, but your big wins are probably going to accumulate, and that's when you basically double or triple your portfolio. So what are the common reasons for the number 4? What are the common reasons for a big loss? I've kind of categorized it into 4. There are a few outliers, but in general, the common reasons for incurring a big loss is either one of these 4. You are basically selling without having patience. One of the typical examples is in one of my videos about the mistakes that I made. I explained one of the shares called Tiziana Life Sciences, where I started investing in it about 80 pence, and it roughly went to about 30 pence. I lost more than half the portfolio. The portfolio was less than half what I had invested. But I didn't sell the share. I knew that the share is going to do well. I had confidence in the company. I had researched enough about the company that I was willing to wait. And fair enough, after a couple of months, the share value started going up. In fact, I even shared it in one of the videos. And now it is sitting at around 1.8, 1.7 pounds, which is nearly double what I had invested. So had I not had the patience and sold it at that point of time, I would have lost more than half the amount that I've invested. But now that investment is almost more than double of what I had done at that point of time. So that's the first thing. If you have invested in a company and you know that the company is going to do well, you need to have patience and wait for the opportunity, wait for it to increase. Eventually, a fairly performing company or a company with fairly good profit, good operations will go up. That's the market model in reality. And then the other concept is chasing after a rainbow, or fear of missing out, FOMO, which is what it's called. I'll explain what this is in another slide in detail. The other option, the third point where people make big losses when the company becomes bankrupt or there's an absolute mess. A couple of examples is Hertz, for example. Because of the COVID-19, they're almost about to go bankrupt. And another company is Finabler, which is the Travelex company, which does foreign exchange transactions in all the airports. Quite huge companies, and they were doing really well, exceptionally well, till the COVID-19 lockdown hit. and their business was completely impacted because of the COVID-19, and they're about to go bankrupt. They've already gone bankrupt. Or the company could go into an absolute mess, like GE, for example. General Electric was a big, huge company, and 3 years back, they made a series of bad decisions. The leadership team especially made a series of bad decisions, one after the other, and the share price, which was sitting at around $35, fell from 1 year. Within a year's time, it fell. I think it was about 2017. It fell from about $35 to about $7 or $8, and was a huge fall for a company that big. But that was an absolute mess because of the bad decisions that the leadership did. But if you've been following that, again, we'll be talking about it in a bit more detail. But the last point is, you're taking a big risk, calculating it based on an outcome, and that outcome doesn't happen. So, which is when you need to be taking the risk based on the certainty of the outcome. If you even feel that there is a small percentage that the outcome may not happen, reduce your risk appetite. Do not invest too much. It's basically a risk versus reward scheme at that point of time. But if you're not certain that the outcome is going to be 100%, then don't invest too much. Take a smaller risk at that point of time. So let's look at a few of the examples. So we've already covered selling without having patience. The other thing where I said I'll explain it a little more is chasing the rainbow, or fear of missing out. It's basically when everybody is saying, buy the share, it's going up, it's going up, it's going up, and you're basically jumping into it in the fear of missing out to make sure that you're catching on to the rainbow of the share price increase. So what happens is, if somebody buys into a share at let's say it's already crossed 100% profit on one day, and you're buying into it after that point of time, right? Then there is every chance that you're actually buying in a peak, and it's going to fall down drastically. It's a unjustified, unnatural peak. A perfect example is a company called Mobility One, which is into monetary transactions. On 21st of July this year, a few weeks back, it was sitting at a share price of about 4.5 pence, roughly about 45 rupees, I would say. On 22nd July morning, there was regulatory news that came saying that there was a partnership with MoneyGram. MoneyGram is one of the world's leading cross-border transaction providers. And this partnership was expected to increase the revenue of the company drastically. So suddenly what happened was, within a few minutes of the market opening, the price jumped from 4.5p to about 16p or 17p, roughly about 400%. And there was a lot of news, a lot of noise about this share, and people started buying in a panic in FOMO into this in fear of missing out in the company. And it reached nearly 57 pence on the same day. It's probably a record for the UK market. It reached about 1,100%. It's about 11 times the original share price, 11 or 12 times the original share price. So there was an RNS released because there's regulations require that if there's a drastic share increase, the company has to explain whether it's justified or not. So RNS was released by the company saying that the revenues are not expected for another few months. And they explained the reality. They explained the nature of the original RNS with the partnership with MoneyGram. And the share price crashed immediately. Within minutes, it crashed to about 15 pence. So if somebody had bought it at, let's say, even about 25 pence, like even about 5 or 6 times once it is gone, they were sitting at a huge loss. And people who probably bought it around 50p, more than half their money is gone. 70% of their money is gone. And they probably have to wait for years before it comes back to this 50p. So they've basically chased on greed and gone into an FOMO mode and bought it at a very, very high price, which was not justified at that point, and that's why they're facing the loss. So anything that is not gradually increasing, anything that is spiked up, always think in your mind that there is every possibility that it's going to drop down soon. So if you've invested, let's say, £1,000, you've lost nearly £700 of your investment, and you're sitting at about 300, £200 because the share price has drastically fallen. So that is what fear of missing out is. And you can avoid it by not investing in anything that has already crossed 100% on the same day. So the next option, I've explained it already, companies like Hertz, Finabler, Travelex, they've all gone bankrupt. Unfortunately, there isn't anything that you can do after it has gone bankrupt. That is why it is important to keep watching a company's performance, read about it, read every news article, every forum, every report that the company brings, every interview that the CEO is giving, every interview that the industry analysts are giving about that company. And if there is a risk to the company with regards to revenue, with regards to the decisions that it's making, or if it's taking a huge risk, then you need to start reducing your liability with the company and start reducing your investment in the company. So that's the only thing you can do. I mean, sometimes companies could be on the brink of bankruptcy and could be bought by somebody else, and that could be a big relief for the company. But most easiest way to avoid this is once the company starts to do badly and you're starting to see the bad decisions being taken, exit out of the company or reduce your portfolio in the company. The other thing, this is probably the one thing that I have done, is risk that you take, slightly higher risk that you take because of a calculated outcome. An example is a company called UK OG, which is the UK Oil and Gas, which is one of the few companies that is doing mainland UK oil generation or oil production. They had applied to Surrey Council for another oil well, to explore another oil well, and the Environment Agency had cleared it, everybody had cleared it. So there was a council meeting that was happening, and there was expected that it's going to be a easy clearance given. But there was a virtual video conference that was happening. I watched it nearly for 5 hours on that day. But there was an utter chaos. Nobody knew what they were voting for, and the councillors didn't have any clue what they were voting for, whether they were voting for rejecting it or for approving it. And eventually it got rejected by just one vote out of all the councillors who voted it. And it was completely against expectations. The share price drastically fell, nearly about 40-50% it fell. Ultimately, the council decision was challenged, and it is going to be reviewed again because the council inspector had actually validated whether it was done within the legal boundaries, and they're going to review it again. But that few weeks that it took from the point that the decision didn't go in their favor, the share price had fallen down and sitting at about half the price that it was from that point of time. So again, sometimes the decisions go well, which is when you need to combine it with point number one. Is the decision going to come back again? Is it going to be reversed again? Is there more chances for it to happen again? Then you wait for it. Patience, basically. So all of these strategies, I keep saying, once you realize some profit, keep top slicing. If you have paper profits and you don't realize it, you don't sell it, no matter what, you're probably going to lose it out, because at some point of time, companies are going to have a fall. So if you have a profit, realize that profit, sell some of your shares, even if it's 50% profit or 100% profit that it has made. If it's just sitting on paper, you're not going to get the money. So, start top slicing, which is basically sell a few of the shares and you get your investment back. Once you get your investment back, everything that is sitting there in that share is basically a profit. That's what I have done in most of my shares. Don't get emotionally attached to any share. Once you get emotionally attached to a share, you're basically waiting for that one share to double, triple. Don't have to do that. You basically, once it has basically crossed a certain percentage that you're happy in your mind, start selling a few of the shares. Start taking out the profit as real money, not just as paper profit. So again, when a company is doing well and your share prices are down, or your invested share price is now higher than the share price that is sitting out there, which means that your value is down, total portfolio value is down. There are a few things that you can do. You can basically average down. I've averaged down on many shares. Decision License is an example. I averaged it down from my original investment because it was down for a few months after I had invested it, or a few weeks I have invested it. So that's one thing that you can do, which means that you don't have to wait for it to go back to the original levels of your investment. The other thing that you could do is you could set alerts. Basically, watch the news, watch every interview about that company. Make sure that you understand how the company is progressing, so you can decide whether you want to reduce or increase your portfolio. So eventually, if the company is doing well, eventually every share price of a company that is not going to go bankrupt will do well, but it will take time. It could take weeks, months, sometimes even more than a year for it to do well. So this is basically what I've been following. I'm not an investor. I'm not an expert. I don't follow charts. I don't follow candles. But I've more than doubled my portfolio in this year and made good profits. So hopefully this video was useful to you. Until next time, see you. Bye. Thank you.